Hello, I'm Sam Schutte.
I'm Rocky Bird.
And I'm Tyler Emink, and we represent Taylor University's Student Endowment Team. Today, we are here to present to you Accenture and why this is the stock to buy for the next 12 months.
Before we talk about Accenture, I want to talk about our performance. Taylor University allows its students to manage $2.1 million of the university endowment. We manage that in a domestic, international, and fixed income portfolio. Since 2003, we have had an annualized return of 10.47 on our domestic portfolio, where the S&P has only had a return of 7.5. So what is Accenture? Accenture is a management consulting company. What they do is they invest in human capital, which enhances the business structure, which increases performance. They're located in 200 cities, 56 countries, and they have over 300,000 employees. When analyzing a company, it is important to look at management. A great manager can make a good company great. Pierre Nuntrem, CEO and chairman of Accenture, is a great manager. He is disciplined, competent, and innovative. He has had military experience. He's been with Accenture over 30 years. And most recently, he introduced Accenture Strategy. Accenture Strategy is the first of its kind to hit the market. It combines business and technology strategy together in an equal and capable manner. Next, we're going to go over the fundamental analysis.
When looking at Accenture's fundamental analysis, we first look at the risk of the investment. Accenture's market cap is at $58.5 billion. The large market cap makes it a value stock, although as we'll see later on, we believe that it has plenty of room to grow. Accenture isn't in a very capital-intensive industry, and so it doesn't require much debt. In fact, its debt-equity ratio is at 0. The volatility of the stock price contributes to its fairly high beta of 1.35. Although, as its weighted alpha of 12.24 shows, it does participate substantially in the appreciation of the market. These graphs show the recent recession from 2008 and how Accenture performed during this time. As you can see, the S&P took far longer to rebound to its value before the recession than Accenture did. Not only did Accenture rebound quicker, but it actually appreciated in about 25% of its value. Next, we look at the current and quick ratios. These ratios show that the company's short-term liquidity is better than the industry average. It should easily be able to handle any short-term obligations it needs. When looking at its profit margin, we see that it is actually lower than industry average. Although, one must keep in mind that due to the size of the company, Accenture is more concerned with the high volume of its sales rather than the profitability of them. In looking at the returns, we see that they have excellent returns on their equity and their assets compared to industry averages. This should console any reservations one investor might have when looking at their profitability. In continuing to look at Accenture's profitability and their value, we turn to the PE ratio, which is at 20.1. 20.1 is right around the industry average. They have fairly promising EPS growth over the last 5 years. Obviously, 2014 might bring down its value a little, but if the up-down trend continues, as we think it will, 2015 should be a strong rebound year, and it is proving to be such with first quarter results in at an increase of 12.17%. When trying to value a company, it's also important that we look at the life source of the company, its cash flow. Accenture's operating cash flow is at an amazing $4.18 billion, and with such a small amount of debt, that leaves $3.49 billion in levered free cash flow. This cash flow, added with the lack of obligations, should scream flexibility financially for the company and its high potential for growth. Finally, we end looking at insider trades. Over the last 12 months, there have been more insider purchases than sells, with most of the sells coming as a result of what we believe to be insiders simply wanting to cash in on the earnings that they've gained during the years. This statistic is pretty cut and dry. If insiders are buying, you probably should be too. Next, we'll look at trend analysis and market analysis.
Before we take a look at the technical and market analysis, we're first going to take a look at the dividends that Accenture offers to its investors. Over the years, Accenture has given a dividend of about 2.3% per year. In order to do this, Accenture has had to increase their dividends at an alarming rate of about 27% per year, which is unheard of in almost any industry. Now, what does this mean to you as an investor? Well, if Accenture was an average stock and increased by about 10% per year, just as the S&P has over the past 100 years, people who invest in Accenture would be making about 12.5% per year, which would mean that they'd be doubling their money every 6 years instead of every 7, which is fundamental to anybody that's looking to invest long term. Now let's take a look at the technical analysis. This here is a graph of the stock price of Accenture over the past 5 years. As you can see, it is highly cyclical and displays high volatility. However, one must still look at the fact that over these 5 years, it has always moved in an upward direction, and year after year, it has always had a considerable increase in stock price. However, you ask if the stock is going to increase over the next 3 to 12 months. In order to have a better idea of that, we must take a look at the 1-year portion of this graph in order to have a better understanding. Now, as you can see, it continues with its trend of being highly cyclical and with high volatility. And it seems to have settled into a channel between about $76 and about $85. And it continues with this channel about until January, where it breaks through its resistance and continues to move upward even afterwards. This is a strong case for why Accenture should be bought. Now, another thing that we must look at on this graph is the 50-day moving average. The 50-day moving average for Accenture is $88.50. Now, it is said that if a stock breaks through its 50-day moving average within the past 15 days, it is on the rise in the stock that should be bought now. Accenture's price today is $90.49. This clearly has broken through the 50-day moving average and shows that Accenture is on the rise and should be bought now. Now, while all this that we've said about Accenture looks great, we still need to take a look at where Accenture fits in the economy. Now, Bob Dahl visited Taylor a couple weeks ago, and he left us with a quote that I like to think about for the upcoming 2015 year. And he said that this may be the year that Main Street does better than Wall Street. Now, what does this mean? Well, it means that businesses are going to do just as well as stocks. And with real GDP growth expected to be about 3%, that is very feasible. Now, where does Accenture fit into the picture? Well, coming off of the past 2 years of a strong bull market, businesses will be looking to reinvest back into their firms. And Accenture is looking to capitalize on this. Businesses will seek consulting agencies in order to come into their company, look at their processes, change them in order to increase long-term profitability. Now, everything that we've said about Accenture clearly presents a case that it should be bought today. However, this isn't just something that we're here to present the numbers on. This is something to show you that we believe in. This is something that we are currently in the process of adding to our portfolio and will be done within the next month. This isn't just a bunch of hogwash that we're here presenting to you today. This is something that we believe in. This is something that we're willing to take the risk on. The only thing that's left is whether or not you're willing to take the risk with us.